Hi, this is Jack Miller. I hope you're having a great day. I want to make this video and talk a little bit about what the secondary market is, or what the mortgage secondary market is. It's a question that it's a little bit of a mystery, and a lot of people ask. I don't want to say a lot of people, but some people ask that question. Oh, before I forget, make sure you like the YouTube. If you have any questions, and like the channel. If you have any questions, put them in there and I'll answer them. So just like everything, I'm going to jump right into it. I apologize. Just like everything else in the world, things are bought and sold. There's marketplaces for just about everything in the world, including debt, mortgages, and all types of debt. And that's called the secondary market. I'm going to talk about mostly commercial debt, mortgages, loans, but the truth is it's the same thing for credit card debt or auto loans or things of that nature, or almost the same. So the secondary market is effectively a marketplace where originators and owners of loans can go to sell the loans. If you think about it, a loan is an asset. I'm going to use as an example. Let's say you make let's say you're the borrower who borrows $100,000, and you owe it at a 6% rate for 30 years, let's just say at 3%. The lender, whoever lent you that money, that $100,000 is an asset, is an income stream to them. So that's worth money. And there's a few things that determine the value of that, which we'll talk about in a minute. But the very high level, in case you turn this off very quickly, the secondary market is a marketplace of people who are buying and selling loans and servicing rights. In a loan, there's the originator, there's the servicer, and there's the owner of the debt. Sometimes they're the same, but quite often they're different. You have the originator is one company, you have the servicer is another company, and servicing rights are bought and sold frequently, and you have the owner of the loan, that's totally different. And all the originator, the owner of the debt and the servicing rights can be sold frequently. Again, they're assets, and we'll talk about it in a little more. Now, why did this come about? Because if I originate a loan, let's say I'm a bank and I originate loans and I need to keep them on my balance sheet, I can only lend out however many deposits I have. It means I'm limited. The secondary market came about many, many years ago, in fact, about 100 years ago, as a way to really fuel the marketplace to make housing affordable. And it took off since then. I'm not going to go into the whole history, but the common buyers on residential side for the secondary market are what's called the agency, Fannie Mae, Freddie Mac, then you have FHA and VA, the government agencies. They're sort of, FHA and VA are onto their own, and Fannie and Freddie are sort of off on their own. Now they're privately held. They used to be quasi-government agencies. But back to it, loans are bought and sold. So let me take it from the beginning. First of all, not every loan is sold on the secondary market, but it can be. And just because it's not the day you originate it, it could be at a later date. So let me walk you through how it happens. And by the way, just to put you at ease, if you're a borrower, even if the loan is sold on the secondary market, and again, if you got that 6% and a 30-year fixed rate, the note and is not going to change. The new buyer of the debt is not going to say, oh, I like you or I don't like you. I'm going to give you a higher rate or a lower rate. Whoever is buying the note is going to keep and honor the terms that the paper was originated at. So let's talk about the three main players in this picture. You have the originator. Their job is to find the borrower, to underwrite the loan, to pre-approve the loan, usually to fund it, but sometimes they don't fund it themselves. That's a whole nother story. So they're the ones who are giving you the rate. They're giving you 6% at a 30-year fix. Let's stick with that. They will often sell the loan to somebody else. Now, what determines who they're going to sell it to, like anything else, it's price. Price is determined. There's a lot of variables in what determines price, but the main ones are the type of loan it is, the interest rate it is, loan to value, things like that. And let me give you a perfect example. I'm making this in August of 2022, where interest rates are very volatile. So if I'm an originator and I originate a loan at a 6% rate for 30 years, that means that's what you're paying me, Mr. and Mrs. Borrower. You're paying me 6% for 30 years. Now, when rates go up, that loan decreases in value. So if I promise you 6% and I deliver you 6% for 30 years, if rates go up to 6.25%, my $100,000 loan may not be worth 100,000. It may be worth 99,000. Loans are typically sold, or the typical benchmark is par, which means 100,000 is 100,000. A 101 price would be 100,000, would be a 101 would be 101,000, but a 99 price is 99,000. So give you an example that I gave. If I originated that loan and I didn't hedge it, or I didn't buy insurance on it, but keep it simple, and the market moved, it's now 6.25%. I may be able to only get for that loan, to keep it simple, 99,000. So I'm going to originate that loan at a loss. That's just the way it works. If I need to sell it, maybe I don't sell it, maybe I do sell it, all depends. Conversely, let's say I originate that loan at 6% and the market moves down at 5.75%. That 100,000 now may be worth more than 100,000. It may be worth 101,000 or 102,000. So like any other commodity, and that's really the point that I want to drive home here, is a debt is a commodity, and the prices go up and down depending on a whole lot of factors. A lot of factors. So the owners of these companies pay laser focus on what's called the secondary market. And typically in origination shops, more money is made, or as much money is made, is originating loans on the secondary market gains as they are originating loans. Secondary market is absolutely critical, and usually one of the #1 people at origination shops is the secondary market guy or gal, whoever's doing that, because that's critical. So an originator is going to sell the loan. Now, they're going to sell the loan, but they also may sell the servicing rights. So for example, let's just say, I'm using for an example, a loan, the servicer gets paid 0.25% on that loan. That's worth something. So they may sell the servicing rights to company A and sell the loan to company B. The owner of the servicing rights, they may sell 2 or 3 times or 4 times. Could be every 5 years, every 7 years, whatever. Companies consolidate. Those servicing rights are worth a lot of money, and the note could be sold as well. So the borrower really has to deal with the servicer, and he has to deal with the owner of the debt. Now, the reality is the borrower doesn't really deal with the owner of the debt. He deals with the servicer. So the point is, there's an originator, there's a servicer, and there's the owner of debt. Loans are bought and sold. It's mostly when people speak of the secondary market, a lot of times they're speaking about residential, but in the commercial world, the space that we play in, or I don't want to say play, that sounds bad, the place we're in, people sell commercial loans all the time. SBA loans are sold. Commercial loans are sold into what's called MBSs, mortgage-backed securities. They're sold into securitizations. They're sold into all types of vehicles. Now, those vehicles are often a pooling of a loan. For example, an MBS, a mortgage-backed securities, you could have a mortgage-backed security for $500 million. And individuals invest in those, as well as in mutual funds and hedge funds. All kinds of people invest in those funds. So when you invest in an MBS, it's really, you're pooling your money. Even if you invest $2,000, you're pooling your money with everybody else. So if one loan defaults, you don't really feel the pinch of it, as opposed to buying a separate loan. So that's really the breakdown. I don't want to say breakdown, a quick overview. Again, remember, secondary market is just a marketplace for the loans are being sold. Now, a secondary market provides tremendous benefit for an originator. It provides almost unlimited capital and much lower cost of capital than he could get or she could get on their own. The downside, which people don't always talk about, people, when things are good, no one talks about the downside, but there's a big downside. And the downside is the secondary market's great when it's great, but when it's not great, it's terrible. And the guidelines in terms of the credit approvals, what loans they're going to buy, the pricing of them, the tranches of them, it can fluctuate on a dime. So for example, when COVID hit, really the secondary market shut down, and a lot of companies couldn't sell their loans and couldn't originate loans, and a lot of them got into a lot of trouble because they didn't have an outlet to sell the loans to. It's happening again now. Again, I'm making this in August of 22. Rates have been moving up, so people don't know what's going to happen with the rates. People don't know what a fair price is. So it's all evolving. So that's some of the downside of the secondary market. And if you're in the business, you know the downside all too well. At this juncture, and we've sold loans in the secondary market, but really for the past 8 or 9 years, we've chosen not to go that direction. We don't sell loans in the secondary market, only because it's just not our business model. So nothing wrong with it. Again, secondary market, I'm droning on here and I apologize. Believe it or not, I like talking about this stuff. The secondary market, all it is a marketplace for buying and selling debt. If you have auto loans or credit card paper, they are saleable commodities on the open market. There are companies who will buy a pool of loans. In fact, today, with crowdfunding and the internet, an investor can go out there and buy just one single loan or invest in one single loan, and buy a loan on the secondary market. I have to give you a disclaimer. I would highly, highly advise caution to an investor doing it. It's treacherous. The yields may sound good, but sometimes the sellers are unscrupulous. The documentation isn't in order. You're much better off investing in companies or investing with reputable companies who really go through the underwriting process and have it down pat. I've seen a lot of people get killed, or I don't want to say physically killed, self-understood, but get financially killed by buying a loan or whatever it may be from just a one-off loan. I wouldn't advise that. If you want to buy loans or want to invest in loans, there's a lot of great platforms. I apologize. There's a lot of great platforms, and you can call us. We deal with high net worth investors and accredited investors all the time to invest money and pool loans with them. But back to the secondary market, all it is, it's a marketplace for loans to be bought and sold in its pure sense. It gets much more detailed. I hope I didn't ramble on too long. If I did, please let me know and I'll try to make a correction. Take care. Have a great day. Remember, leave your questions and comments. Take care and have a great day.